Hi, I'm Peter Rose, founder of Longwood Currency Trading. Forex account danger. Look, if you're trading 3 lots or more, if your account is large enough that you're trading 3 lots or more, you could be in danger of losing that account. You don't hear many folks talking about the loss part of the equation. It's all follow my system and you're going to make hundreds of pips a day or something stupid like that. Bollinger Band secrets or whatever. Your likelihood of success in that is slim to none. Taking your $500 and running it to $10,000 is slim to none. You have to have a lot of patience. You have to have a lot of skill. And you have to be really, really careful in order to do some of the things that are being touted as practical methods of trading. The problem you're faced with, there's 2 problems. When you're getting started trading, in other words, you're not trading 3 lots, you're taking $500 and experimenting or trying to get your trading basics grounded so that you have some fundamental understanding of the trading process. You have that phase that you go through, and then either you drop more money in your account or you're able to work your way up and add money to the account, and you have the capability of trading 3 lot positions or larger. And I'm not talking about trading 3 lots under 100 to 1 or 200 to 1 leverage. That's just asinine. But when you're in that 3 lot capable position of trading in reasonable leverage, under a lot of the guidelines that I've outlined in my video, you don't have to be as stringent as I am in my trading. That's just my risk management methodology. I'm successful with that. Could I make more money on a daily basis at 100 to 1? Yeah, sure. I could make 3 times more money, 4 times more money. The problem is when it goes wrong, it'll take the whole account. And that's the problem. And it's a problem when you are in that 3 lot trading capable account size, regardless of the leverage here. But just when you get to that point where you're ready to start trading those 3 lots, you're in a very vulnerable position. If you're trading a single lot, for example, it's $10 a pip, yeah? So you take a 10 pip hit, you're 100 down. No problem. I mean, $100 is a lot of money. Let's have respect for that. But in the large scale of things, when you're trying to make a 30% return or something like that on your account, or you know what you're doing and you're growing it, you understand that you're a 60-40 trader, so you lose $100 4 times and you win, what, $200 6 times or $150 6 times. You're coming out coming out above ground on that trading, and so you've got some confidence in what you're doing in order to put a 3 lot account size position at risk in your trading. For me, and I don't suggest that you do this, you're not a student, you're not following my trajectory, so it's okay. I've got to have $10,000 for every 1 full lot that I'm going to trade. If I'm trading many lots, I got to have $1,000. Now in the U.S. here, and we're in 2024. This is early February 2024, just to put context to it if you're listening to this 10 years from now. But in the U.S. right now, you have to have a 5% margin, 5% of the cash value of the position as margin. So today, if you're trading a mini lot, you need about $600 in margin to trade one of the majors, let's say. If you're trading a full lot, you need about $6,000. So the $10,000 gives me $4,000, for example, of runway. $4,000 on a lot, that's 400 pips, right? So that's, you say, well, man, that's a lot of room to go. Yeah, but there's a probability that if you're an active trader, you're going to lose 6 times in a row. So if you're pushing the envelope on several positions and you drop 6 in a row and you go, oh, I would never drop 6 in a row, I'd get out. No, you wouldn't. No, you wouldn't. That's the problem when you move into trading 3 lots, is that you're invested more not only in your position analysis, but also in the amount of money that you're putting at risk. The thing goes $200, $300, $400 against you, and you go, oh, it's too much, it'll come back. You don't do that when you're trading a full lot. It's $100, it's gone. I'm out on a 10 pip stop, right? You do a 10 pip stop on a 3 lot, it's $300. If you made $300 a day, 5 days a week, like you were at a job, that's $72,000 a year. So you bet your ass that $300 is going to freeze you up. And that's one of the problems when you make that transition from trading that beginner level stuff, and then you go into the scale of trading 3 lots. At 3 lots, you can start making some significant money. If you were really good and had an 80% win-loss, you could maybe average $300. You maybe take that 3 lot position and run that to $60,000 a year, which would replace your job income. I don't think it's likely that you're going to be able to do that. I think you got to think conservatively here. If you can get 20% a year compounded on real estate, you're taking a little bit more risk in currencies, so you expect to have a higher percentage return, or you shouldn't be doing it. If you don't have the skill to get a higher return than 20%, then you shouldn't be doing it. The fact that there's a lot of pressure out there of folks that are taking small accounts at super high leverage and making $3,000 a day, $10,000 a day, and they can point at their Lambo and say, I got bought this Lambo, 2 years ago or 3 years ago. You look, if you're trading at 200 to 1 or 500 to 1 and you got a $10,000 account, you can run that to 6 figures in 6 hops. So, and then you could take those 6 figures and run that to $1 million fairly quickly. But is that consistent? Are you going to be able to hold that? Most of the folks that I've seen who have done that in the beginning are the same ones now that are saying don't risk more than 2% of your account, don't do this and don't do that. That's all bullshit to start with, but it's imperative for them because they really don't understand how they traded, how they got it. They just got lucky as they went through, a little bit of skill, but now they're more in a mode of protecting that money than they are of doubling that. Oh, let's take this $10,000 account and double it. So you throw shit against the wall and, I got $20,000, $30,000 from that 10 at high leverage. Oh, okay, we'll take your $1 million and do the same thing. It ain't going to happen. It ain't going to work. Take $100,000 and try to do that same thing. It ain't going to work. You're going to freeze. You're going to have problems. And that's the danger that you start facing at the 3 lot position, because the loss points that you're going to be taking, if you're taking 20 pip losses, you got to be a pretty good trader. If you're not, you're going to be upside down on your win to loss. You're going to be upside down drastically on your dollar value win loss. So you have to be reasonable about what you're doing all around, all across the board, because otherwise you're going to get in that 6 running loss probabilistic situation. Your account's going to go to the wood, and you're going to wonder, what happened? How did this happen? How do I know that? I've hit runs of 6 losses in a row when I started trading. I haven't had that on a large scale since I've been trading a 6-figure account, because a win to loss doesn't really factor in when you're staging and building and all that other sort of stuff. You have to use other metrics than what you would talk about as a beginner trader. If you're doing beginning trading, then win to loss ratio is really a critical equation, and I call it equation. It's not a ratio for you to look at, so that you can have confidence when you step up to the plate and you're swinging a 3 lot bat instead of a 1. Because that will give you the confidence that your process is right. So hopefully by that time you've been trained or schooled or self-educated to understand that trading is a process, and it's trading that you want to learn, not how to do London open or golden crosses or Fibonacci's with an RSI or any of that crazy voodoo that people think that works. That it doesn't. I've got a bachelor's degree in physics, almost a minor in math, 40-year career in real estate. I think I know what I'm talking about, and there's no correlation between any of those indicators and what you're doing in the currency market. Under the assumption that you do know what you're doing, you still have to be aware of the difference from a psychological standpoint and from a strategic standpoint, that there are changes that will take place when you go to that 3-lot trading capability. There'll be another transition that happens when you get, to me, if you're working with me, in that 8 to 10 lot trading bank capability. There's another jump in the way that you have to manage that trade. You do things differently. And it's at that 8 to 10 lot capability that you begin to break away from your reliance on win-to-loss ratios and all that other stuff. I do win-to-loss ratio and average win values and all that stuff now, not on a transaction basis, but on a daily basis, because I'm trading for the long run now with 6-figure account. And so if I make, the other day I made $2,800. Yesterday I lost $500. Day before I made $2,800. So, you look at the day, what happened in the day, not on a transaction basis, because you're dealing with a large set of numbers when you look at a daily value and you've been trading for a while, as opposed to when you're just getting started and you might have 6 months of trading or something like that. You don't have a large sample size of data. The only sample size of data is your transaction register, and so you use what's there, because that's a direct reflection of your trading ability is based on a transaction basis. Even if you're making 4 or 5 transactions a day, you want to know what that per transaction win-to-loss ratio is. Well, when you get up to trading 3 lots, you got to be careful about trading multiple times a day. You don't want to be breaking that up into multiple transactions. You're all in, all out. I mean, these are all things that I've talked about so much in my videos. And the reason I'm bringing this up, this FOREX account danger thing that circles, that's around that 3-lot capability, is because, well, this is the first of the year, February 2024. At the end of a year, all the financial folks are scrambling around to either make things good, get their stuff in, so that they can close out all their positions for tax purposes at the end of the year. You just have to do that, because if you don't, I took a horrendous loss in 2022, because I had this running loss that I was confident was going to come back, but all of a sudden I realized I'm in December. And if I carry this loss forward, it'll show as a win on my books. I'll pay taxes on this phantom win that I didn't have, and then if the position loses, I lose that. So I lose twice. And so I just took the loss. It was almost 6 figures. But then instead of paying $40,000 in taxes on the gain, if it had gone through, I had now got a tax loss carry forward of $3,000 as it goes forward. That's U.S. tax stuff, so it might not be applicable to you. You might not even have to worry about tax consequences. But generally, you're going to notice that price action, whether you're doing stocks, commodities, currencies, old tire, doesn't make any difference. People are reorganizing their portfolios at the end of the year. Clean the deck, set it up, lock down the books for the end of the year. I mean, if you're on an accrual basis, maybe your accounting system starts at a different time, and that's okay. But generally, currency traders are not going to be on an accrual system, and you're not going to be position traders. So everybody's slamming the door and getting ready for the new year. So now when we start into the new year, we've got an entirely different mindset. Okay, I'm starting over again. I'm starting to do this. So that's the kind of the period that we're in right now, and why the emails that I'm getting are full of fear. What am I going to do? This is what happened last year, and I am trading 3 lots, I'm trading 5 lots, and Jesus, I flatlined out. I don't understand what happened. I'm coming into the new year, I've lost $4 or $5 or $10,000 or something. I don't want that to happen again as we start the year, because you're starting fresh, so you take a different view of it. So if you're trading that 3 to 5 lot or 3 lot position or greater, you've really got some decisions that need to be made. I hope my videos are helping you. Go back through the videos and take a look at them, because they'll give you a better sense from somebody who's being honest with you. When I have a failure, it's up front. And if I have a win, I'll tell you what the win is. Now, yeah, I lost $500 yesterday. I was trading a 5 lot, so I took a 10 pip loss. That's $500. $500 is a lot of money. The 10 pips isn't a lot. So if you take a 10 pip loss on your single lot, you lose $100. If you're trading a mini, it's $10. I'm just not interested in making my comparisons for folks that are trading mini lots, because you're not going to pay your electric bill with a mini lot. You know, you're going to need a full lot or a couple of lots in order to just come clear with a couple of $1,000s a year to pay that light bill. That's your first goal that you're going to want to train. When you finally get to the point where you understand trading, and then you're ready to start making money, because until you understand how to trade, you better be trading for pips and not for dollars. As soon as you start trading for dollars, it's a whole different skill set, and if you're not being trained for that, you're putting your account in danger just for that, let alone going to the 3 lot position. You'd be trading mini lots, and you could put your account in danger. I didn't understand that when I started trading. I've been looking at the currency markets since 2007, and I didn't start really trading until 2012, because I was doing it as an academic exercise. And I've been involved in the financial markets one way or another. I traded options for 4 years, but I've been involved in the financial markets since the mid-1970s. I've been around all the corners there are to get around. So when I mentioned something about, I took a $500 loss, and it's the same as if you took a $10 loss, you can't look at the dollar value, because that'll freeze you up. But a lot of folks that are contacting me are in fear. You can't be fearful trading, and if you are fearful, there's some easy steps that you can take in order not to be fearful. But it involves a serious view of what are the rules that you're using, and why are you using those rules. If you can get that right, you have a much better attitude toward what you're doing as a trader, and you're more likely to be able to say, hey, I made 8 pips today, or I made 6 pips today, or whatever it is. Yeah, you're losing 10 when you trade, but maybe you're when you hit a winner, it's a really strong winner, and so you're ending up, from a dollar standpoint, maybe jump ball. But if you don't understand the trading process, you're not going to understand how to fix that. I mean, that's the thing that I think when I am working with somebody in a consulting process or taking a course, is that there's some strong emphasis on the metrics, so that you can take a look at and manage better how you're calculating what those rules should be, and how you're applying the rules strategically into your trading on a daily basis, because you're at that 3 lot level, and so you're not thinking tactically at the transaction level anymore. You're thinking a bit more in terms of, well, I'm working here to try to make my light bill. Or if you're trading, you're getting up in the 5 or the 8 lot position, you could very well be taking a huge chunk out of that job income that you're trying to replace and get out of. So, but you're only going to be able to do that if you're being reasonable in what you are looking at as target goals, your risk that you're taking, and the size of the bank that you're using, so that you understand psychologically how you're going to react to the dollars if you're not, if you haven't been consistent in your trading, so that you feel comfortable that, oh, I can take a couple of $1,000 loss here because on average I'll take a couple of $1,000 loss 4 times, but I'll make $5,000 the other 6 times, and I'm way ahead of the curve. You can't come out after a calculation like that over a 10 trading things as a 60-40 trader and say, oh, well, I ended up making $2,000. I lose $4,000, I lose $1,000 4 times, and I make $1,000 6 times, so I'm $2,000 up. I've got $2,000. That's a shitty return on the kind of risk that you're taking there, because that $2,000 has to be divided by the 10 trades that were done in order to create the $2,000. Now you're making $200 a trade, based on what bank size? $30,000 bank size, $50,000 bank size. You're making $200 fucking. I don't think so. You have to be really careful. Okay. So I hope that this video has. It certainly hasn't helped you, because I haven't really taught you anything here. I'm certainly simply trying to make you aware that if you're in that target group that I can help, that 3 to 5 lot, mid to low 5-figure account size, you need to be aware of certain things that could happen when you hit that 3-lot capability trading level that you're not going to like, because it could put your entire account at risk. Peter Rose, Longwood Currency Trading. Have a good day and have a good trading day.